along, ladies and gentlemen. I'm here on that. We have with us Rajni Thakur, Chief Economist at RBL Bank, joining in. Welcome to the show, Rajni, and a pleasure to speak to you today. Rajni, absolutely. Rajni, my first question coming to you is, overall, if you see, we have the CPI numbers, firstly, that came in at 6.95%. And that overall is significantly above what the street was estimating as well. What could you make of this number? Because 6.1 is what we saw in the month of Feb.
So yes, we had the CPI number that came out last evening. There are two parts to the question you're asking, Hiral. How is this 6.95 panning out in terms of what was expected, and B, how does it go forward from here? Where does it go forward from here? So first, do remember this is a data for March, and March was the month where crude had hit 132 as well. So there are multiple factors right now running when we look at inflation trends in the economy. A large part of it is imported, not only coming from crude oil. If you kind of de-thread the inflation data, you'll see lots of it is perishable food, vegetables, fruits, eggs, milk, and edible oil. Again, something that's important. So there is food inflation, which is coming from imported sources. There is transportation that's coming from imported sources. And there's also core pressure that's increasing at this point of time. So we have two underlying trends working at the same time. One is a large part of imported inflation getting passed through. Second is the post-COVID normalization that we've seen in terms of core demand levels as well. Now, while the first one is definitely not favorable, the second one shouldn't be written off altogether. There are parts of that second trend which is favorable for the economy and the growth outlook going forward. If you are a policymaker, it provides for a very difficult backdrop at this point of time. You have inflation running high across the globe. Last night, we also saw US inflation running at 4 decades level. You have crude dependence for the economy and crude prices not relenting below $100. That kind of puts a cast of doubt in terms of what to expect for the next year. But do remember, this is March data. It was for last fiscal year. We just about started on the new fiscal year. The growth outlook, more importantly, the inflation outlook is very dependent on how does oil price pan from here. What RBI has done in its latest forecast is assume the prevailing pump prices, quote unquote, for its expectation onto the next year. I would say there's an equal chance of oil averaging at 80 and oil averaging at 130, as much as oil averaging at 100 for the year. We are we're just barely 15 days into April. The whole fiscal year is yet for us to pan out. But at the same time, if you see the cyclicity of oil prices, consistently high oil price tends to cut on oil demand level automatically on its own. It's one of the cycles that works fastest in terms of high price cutting onto demand level. That's something that both the oil cartels, oil producers, and oil consumers are very, very aware of. You've seen that happening in many of these OPEC plus discussions in IEA projections. If oil prices do indeed remain above $100 for a sustainable period, which means between 1 quarter to 2 quarters, you will automatically have a year where second part of the year has lower demand, largely because of high oil prices cutting the inherent strength in demand levels at this point of time. So either ways, oil should likely trend lower in the second half of the year, and we should probably have an average for the year not higher than $100 is my base case expectation at this point of time.
Right. So to this as a continuation, when COVID started again, all eyes were on the rural growth story. Similarly, if you see the inflation as well, clearly the print in terms of rural inflation is much higher. And while urban inflation has been slightly muted, do you think that is actually suggesting some near-term pressure with regards to rural consumption? And that's something which could have an impact with regards to the rural growth story as well?
So rural terms of trade has been very favorable in last couple of years, largely because of lots of support that came because of the COVID-induced landscape, and also because of all the support that came from the government sector policy-wise. Yes, at this point of time, there is a higher price pressure ailing the rural economy, but I think the underlying story, both on the rural and urban side, is more on the demand level. So if we keep aside the oil and inflation story, I think it's important as an analyst in Indian economy to figure out where is the underlying demand, income, and hence consumption level kind of working around. Now that we are in the post-COVID, hopefully past the worst of post-COVID world, the underlying demand strength has to come from income levels. To that extent, we see pain both on the rural side and on the urban side. You know, the rural Manrega work demand, for example, hasn't really relented yet. On similar side, we've not seen the kind of recovery on urban informal sector in terms of demand and activity level. So as an economist focused on India, I think we are still watching onto concrete signs of demand levels getting past the pre-COVID level onto the growth path. And that would be a bigger factor in estimating growth outlook than inflation really at this point of time.
Right. All of this said and done. So if you have to look at, say, the next 3 consecutive quarters, that's the fourth quarter of FY22 to the second quarter of FY23, do you think that the CPI inflation may exceed the 6% target, taking the current print into consideration?
So here I would, to be fair, keep out the fourth quarter of FY22, largely because there was some bit of Omicron-related normalization, Omicron-related pressure, then normalization, and then the whole geopolitical development that kind of impacted the immediate price level. I would focus on the next 3 quarters. Right now, given the current prices and the current core inflation pressure, I would see around 6 level going forward for next 2 quarters, definitely. The third quarter, the September to December, is something which still remains questionable in terms of understanding how do these prices play out and how do the demand levels play out. But for Q1 and Q2, very close to 6% level for inflation.
Right. And then overall, with this kind of inflation print that we are seeing as well, what's the view do you expect with regards to the RBI stance? Do you think the stance could change to neutral from here on, seeing the inflation print? Secondly, do you see upside risks with regards to where the possibility of a rate hike goes in FY23? Because overall, around 50 basis points is what the street was estimating in FY23. But taking this number into consideration, do you think it will probably then see a possibility of a 75 basis point rate hike?
So I have 2 parts to what you've asked. First is there is lots of market expectation building around, particularly after the last RBI policy in terms of aggressive rate hike and inflation pressure kind of pushing RBI to hike rates very, very quickly. Let's keep in mind 2 things. By RBI's own projection, the second half of the year has a growth outlook of 4% handle. Now, by any measure, that's not something that makes a case for aggressive rate hike atmosphere at that point of time. So it kind of doesn't add in well, let's put it this way. So short term, there is pressure on RBI to match up with global rate hike cycle and also crude prices coming in. I see that pressure easing off starting second quarter on, and we might not see as aggressive a rate hike cycle that market is expecting at this point of time in the second half of the year.
Right. So overall, with all of this said and done, how are you expecting the bond yields to react? Do you think there is likely to see some more upside with the CPI reading? But if any spike is likely to be met with RBI intervention of some sorts?
So bond prices has 2-3 major drivers at this point of time. There is a government borrowing program that's still not been discussed either by RBI or government, but it will start impacting bond yield expectations sooner or later as we get into the year. There is global or particularly US yield that's still rising. We've yet to reach a point where US tenure has kind of peaked. The expectation is that US inflation has peaked. So hopefully next month on, we should see an easing off for global yields. And then there is definitely Indian inflation pattern as well. That's, that trend is expected to go up further in next couple of months. So lots of pressure in bond yield in the short term. I would put it between 2 to 5 months period. But as we get into the second half of the year, second half of the calendar year, we should see some of these pressure easing off and focus shifting towards growth, both for the bond market and for policymakers.
Right.
At which point probably government borrowing program will become a bigger driver.
Right. And as you're mentioning about the borrowing program as well, with regards to where the government goes, the CAD, which was at 2.7% of GDP in the third quarter of FY22, and the first half of FY23, the borrowing is at around 59% of the budget. What do you make of this? How are you seeing this? Because clearly, if you see in terms of divestments as well, expenditure side as well, what does the entire gamut look like for you?
I mean, the budget lays out a borrowing size of 14 to 15 lakh crore for the year. Now, that's something that definitely the domestic bond market does not have the capability wherewithal to absorb that kind of a bond supply. Around 55 to 60% of it in the first half, as per the calendar, is something that's usual. That's been the trend for many years now. So that was expected. Nevertheless, it's not a small number for the market to absorb. Is the government and RBI considering some other players in the bond market is something that we've not seen any clarity on. But my expectation is that somewhere in the middle of the year, we should see some more clarity in terms of some foreign investors coming in onto the bond market as well. And that should ease that pressure. But given the multiple pressures at this point of time, I mean, anything between 725 to 750 actually looks very, very plausible for the bond, 10-year bond itself.
Right. And overall, how are you viewing the fiscal deficit side of it?
There are too many moving parts at this point of time. I would still wait for some of the disinvestment, the particularly big one in terms of LIC that's now moved on for May. There are a couple of other disinvestment pipelines that are to come in. I would wait for some clarity on growth, underlying consumption and growth pattern, because that would decide on the pace of capital expenditure from government account as well. I would wait for some clarity on bond inclusion or some sort of, some other bond players coming into the Indian market. So too early, we've just 15 days into the current fiscal year. Let's give it a couple of months for the clear trends to show move away from geopolitical and COVID pressure that we saw at the start of the year. And then would be the right point to assess it. There are multiple pressures at this point of time, but my base expectation is that we would soon move away from the volatility we've seen in asset market and get on to the growth and fundamental patterns.
Right. So Rajni, very lastly, what is your growth expectation? Because the real GDP growth for FY23, which is projected at around 7.2%, down from a 7.8% earlier. Assuming how crude prices are going to pan out, where do you see the growth number?
So Hiral, I think there's not a single economist on street who's now has this one number as a target. All of us are working with 3-4 scenario analysis. If oil stays as 85, if oil averages at 90, 100, 120, all of us are working with the scenario analysis. At this point of time, 7 looks a more plausible number. So 7.2, more or less in the range of RBI in that sense. Only as we move into the second quarter and we get more clarity on oil price trend is when we'll really be able to move away from our scenario analysis onto a hardcore target. But at this point of time, as I said, 7 looks more plausible.
Absolutely. A lot of moving parts overall that we're seeing across parameters right now. So to pin down on a particular number, absolutely not possible. These always continue to remain expectations and assumptions. Thank you, Rajni, so much for joining us on the show. A pleasure to speak to you, get insights from you. Thank you. Stay safe and speak to you soon again.
Thanks very much.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.